Hello and welcome. You're watching NDTV Profit, and over the next half an hour, we will talk about everything that's exciting in the mutual fund universe. Of course, the market's having a quiet afternoon. It's not looking too great for the street. The breadth is also fairly weak, but let's go into some more interesting stuff, which is what you should be doing with your money and your portfolio. These are tough times to navigate. And with all that talk about global markets outperforming India, the question to ask is, should you be adding allocations to other geographies? Rishabh Desai, founder, Rupee, with Rishabh and Nisreen Mamaji, founder and CEO of MoneyWorks, both join in. Thank you very much for joining us, both of you. Rishabh, will start by asking you this. When one is building a portfolio, we constantly and often talk about the importance of diversification. We also talk about the importance of not over-diversifying your portfolio. What I do want to ask you is, how important is it for somebody in a wealth building stage to have geographical diversification on their portfolio?
Hi, first of all, thanks so much for having me on the show. This is a very important question which you just asked, and a lot of people today are concentrating on India, which it is very much rightly so, as India is growing at a substantial growth rate, and it's the fastest growing economy, emerging economy globally. But at the same time, let's not forget that other economies have also delivered substantial returns and growth. For example, like the US, over the last 10 years, if you compare it with India, US has actually outperformed, right? So also US has a lot of other benefits, like because the companies are giant, they have global presence. We are communicating via Zoom, which is a US owned company. So I feel that geographical diversification, especially in the US economy, is utmost important. Apart from all of this, the currency is also very strong, and currency appreciation also plays a very important role. So I feel, having some exposure, especially in the US markets, anywhere between, say, probably 5 to 20% is utmost important today.
Right. Nisreen, what are your thoughts, right? I mean, all of us who live in India have a home bias. And for obvious reasons, any investor is and has a home bias because this is the only market we truly know. In your opinion, how important is it to diversify your portfolio across geographies?
So, yeah, as you rightly said, there is a home bias. But it's very important not only to have the geographical diversification, but also certain industries, are not represented in India as yet, or, we are not completely, in the space, like say for digital especially. I'd like to draw an example. Investors can now invest in, certain international funds. I'm talking about the Nippon India Taiwan Fund, the Nippon India Japan Fund, the Hang Seng Fund, which had closed down subscriptions until October 15, 2024. On Feb 2nd, 2022, we were not taking any more subscriptions via lump sums, switches, SIPs or STPs into these funds. But typically, I'd like to draw your attention to the Nippon India Taiwan Fund. It's an active equity fund, and it enables investors to diversify into select Taiwan-based stocks, such as the semiconductor giant Taiwan Semiconductor Manufacturing Company, which has the highest weightage of 8.2% in the fund. The top three stocks are, in the technology space with a combined weightage of about 20.35%, which are Taiwan Semiconductor Manufacturing, Asia Vital Components, and Gentech Precision.
Nisreen, we'll talk about the funds in a minute. I just want to help our viewers understand the importance of this, right? Products apart, I think at a portfolio level, we need to get a better understanding. Rishabh, I'm going to come back to you for this. We all in some way or form have a global exposure, be it travel, be it families who want their kids to go study abroad. Of course, the wealthy also have one leg outside in most cases. The reason I ask you this is because while we have an expense side to global markets, we don't often have an investment side. Also because the government of India has not made that very easy with LRS, right? So the usual understanding is that if I want to invest in the US, I need to use my LRS. But that's not completely true, right, Rishabh? Because there are other ways to do the same thing without actually exhausting your LRS limit.
Absolutely. I completely agree with you. See, gone are the days where the rich and wealthy and the ultra rich could invest abroad. Even now today, with a simple product like mutual fund, you can invest. A retail investor can take global exposure and invest abroad through Indian AMCs, right? Unfortunately, what is happening right now is that the Reserve Bank of India has restricted investing in in the offshore market because there is a 7 billion US dollar limit, and it rightly so, because the Reserve Bank of India wants to protect the Indian currency and the Indian growth. But at the same time, I think today we are living in a very globalized, interconnected world, and with a click of a button, you can actually see the markets, how they are panning out abroad, and make quick decisions of how to invest, when to invest. So I truly feel that apart from the LRS route, I think with a click of a button, if Reserve Bank of India further increases the limit, I think there will be more inflows, because now if you observe pre-COVID, pre-2020, there was not a lot of awareness, how one should invest globally, what products. Now there are so many different products, both on the active and on the passive side. So I think today, rather than looking anywhere else, I think mutual funds is a one-stop destination for everything, whether it is equity, fixed income, commodities, or even offshore investments taking global exposure today.
You're so right, Rishabh, because the world has come a long way. I mean, when we open the markets every morning, the first check we do is how Asia is doing and how the US handover has been. So all that talk about deleveraging or decoupling hasn't played out. But Rishabh, on that note as well, my next question to you is, what is the ideal allocation one should be making to global funds in a portfolio for an individual who's got an average risk profile, but looking at wealth creation?
If someone, okay, first of all, see, there are many geographies where mutual funds and companies invest today. Okay. There is the China market, the greater China market, which combines China, Hong Kong, and Taiwan. There is a European market. There is the Asian market. There is, of course, the US market. So now mutual funds do invest in a lot of different geographies, and there are products like global funds which invest in a combination of these geographies together. Now, to put it very simply and to answer your question very clearly, the average risk taker should only concentrate on the US economy. There are three typical reasons why. See, one is the US is the largest economy today, let's not forget that. Second is that US is a very consistent growing economy as well. And third is that US as markets and companies and as economy is very transparent also. See, today, if you see that greater China and the China region, it's not, unfortunately, not very transparent. So you actually don't know what's happening in their economy. Although, of course, they do put out data, but again, it's not a full democratic country. So it's very difficult to predict what their government policies would be, or what their company, or what their growth trajectory would be, right? So I think if someone wants to take a global exposure at this point of time, although, see, I feel there is tremendous upside opportunity in the greater China region, but there are, and of course, the Chinese government has given a good stimulus package, but today, that rally is short-lived. Okay, and we still have a long road ahead to see the China markets in the recovery phase itself. Forget entering into a bull market. So at this point of time today, I think if someone wants to take global exposure, there is only one economy what I can think of is the US economy.
So right, because everything else in Asia right now seems very tactical, right? And it's so tough to understand the dynamics that happen in those markets. Nisreen, in your opinion, what is the ideal allocation to global funds one should be looking at a portfolio level?
So I think we shouldn't go beyond, 10 to 15% in the portfolio, as you mentioned, for an average, risk taker, because, Rishabh has already mentioned some of the points. But having said that, if you have certain goals of, say, sending your child for a foreign education and you want to lock in the dollar at the current rates, so in those cases, definitely we do suggest a higher allocation, because, in say 10 to 15 years down the line, you are planning to send your child to university, perhaps in North America or in Europe. So, if you have a specific goal in mind and you have, say, 30% of your portfolio or your SIPs working towards that goal, then yes, definitely it makes sense to have higher allocations. So on a case-to-case basis, the decision would be obviously different. But by and large, I think don't go beyond 10 to 15% of your portfolio for an average risk taker in any equity, in any international fund, whether it's Asia or the US.
Right. Rishabh, nowadays a lot of retail investors do understand and believe that they have a good understanding of tech stocks, for example, on emerging themes in the US, right? And I know this has also become quite easy because there are so many platforms now that make it very accessible to go out and buy an NVIDIA, for example. What do you recommend? Do you feel like allocations to global markets should be made directly, or is it always better to do it through a fund or a local fund manager?
See, I would always go via the index fund route, actually. It's very simple to track, very simple to invest, right? And very simple to monitor also, because you don't know what's happening in their economy. And a retail investor may not understand all the nitty-gritties, the technicalities of their economy. See, although we all understand and the retail investors today have definitely become smarter, and we all understand how the markets function, as how we see, their NAV, especially the S&P 500, Nasdaq 100. But I would still stick with simple, plain vanilla index funds like S&P 500 and Nasdaq 100. If you see, actually, when the US markets fell after COVID, it has rallied substantially. So you can actually track and monitor it in a much more easier way. If you fall into this cherry picking of a particular stock, you may end up buying a wrong stock at the wrong time also. So that's a very big risk what a retail investor is actually taking. So rather than going into the direct stock route, I would suggest a plain vanilla S&P 500 and Nasdaq 100. Also, one more additional point I would like to add, since see, the US economy and the US growth is struggling, and the US Fed is doing everything it can by cutting rates and pumping more liquidity to make sure that the growth comes back in action. I truly feel during this rate cut phase, the tech stocks, so especially Nasdaq 100, can do well. So I see a good upside opportunity in Nasdaq 100. But keeping that in mind, the valuations still remain very expensive. So I think an SIP methodology would work great today.
That's such a good point to make. Passive investing is probably, very underrated and not usually sold because I guess distributors don't make too much money on it, but may just be the right way to create significant long-term wealth. Nasreen, you want to have a go at this? There are a few active funds that have now, of course, started taking allocations. In your opinion, what is the best way to play a global allocation? Do you do it through passive ETFs, invest them in a staggered manner, be disciplined about it, or would you go and invest into active funds playing these specific geographies?
See, a lot of these funds are also, fund of funds, which are feeding into the international funds. So what is available in India today, you can have the ETF options, or you can go in for a fund of funds, which is particularly, investing in an ETF or an index. So that would make a lot of sense. I think for, Indian investor, as rightly mentioned earlier by Rishabh also, a disciplined fashion to go in with an SIP would be a very good way to go about it. But, don't allocate too much on the international funds because, we do have a lot of investors, in fact, NRI investors investing into the Indian markets and also, undertaking the currency risk. Even after subtracting that, you still will make a lot of money in India. So, 80 to 85% of the portfolio should have a home bias. 10 to 15% you can invest into index fund or a FOF rather than buying direct equity and going through the LRS route, etc. A mutual fund is a completely holistic, product that can give you a lot of ease and convenience of investing in the international markets. Through an index fund or a fund of funds. I mean, and also select a FOF, which is available over here, which is a feeder fund into any of the international markets, whether it is in Asia or the US.
Now, Rishabh has already mentioned how he prefers the US equity as opposed to any of the other emerging market or Asian markets. Nisreen, what are your thoughts? Are you recommending to your clients to add a little bit to the Japan, Chinese, or the Taiwanese market? And the reason I ask this because while it may not be strategic, a tactical allocation could be warranted, you think?
Definitely. Like I said earlier, there is particularly there's a Nippon India Taiwan fund, which, doesn't, these sort of industries are not very well developed in our country, like the semiconductor, space. as well as I said earlier, the Asia Vital Components, this Precision Industrial. So, 2, 3 of these companies are about 20.35% of the fund. So if we are anyway looking at, this particular sector doing very well internationally as well as within our country, and we don't have exposure to these particular industries within our country, then we should be looking at it. We also have the Nippon India Japan Fund, which has an equity fund, which is an actively managed fund. It has the top Japanese companies like, Daikin, Hitachi, and Tokyo Electron. So unlike its tech-heavy Taiwanese counterpart, which is the Taiwan Fund, the Japan Equity Fund is tilted more towards, consumer cyclical. So you're getting a very different flavor with the Japan Fund. Earlier in the month, mutual fund investors were lured into the China-based mutual funds as well, following the nation's largest economic measures. So investors can now look into the Nippon India, Japan, or the Taiwan Fund, as well as other Asian equities. We also have the Hang Seng Bees Fund of Nippon, which is an ETF. And basically, it also corresponds to the total returns of the securities as represented by the Hang Seng Index. So these are a few of the funds that we should be looking at. We also have the Nippon India US Equity Opportunities Fund, and this will provide you long-term capital appreciation by primarily investing in equity and equity-related securities of companies which are listed on the recognized stock exchanges in the US. And the secondary objective is to generate consistent returns by investing debt and money market within the country itself, that is within India. So you're getting, exposure to 4 or 5 different geographies and certain industries which are not yet developed in our country. So definitely for diversification purposes, you can look at any of these actively managed funds.
Rishabh, your bias clearly is more strategic, right? So you're not going to play the tactical game, which I guess for a long-term investor is very important, because while taking a call on a geography on a tactical nature is always hard, because you've got to take 2 calls. One is entry and the other being exit. But just elaborate on that. There is the Mirai Asset NYSE FANG ETF, right? The reason I ask you this is because a lot of the themes, a lot of the companies that are pretty big in the semiconductor or tech space are also listed on the New York Stock Exchange or listed on Wall Street. Do you feel like that gives you a lot more comfort to buy into stocks through a fund which is focused on US equities or US listed companies? So it gives you an indirect exposure to the big stories in Asia.
The FANG Plus index consists of, the 10 global innovation companies, right? And more or less, these companies are covered either in NASDAQ 100 or, or the S&P 500. It's only, and the FANG Plus index is a very concentrated index. And, Mirai Asset has managed it very beautifully well, actually. See, at one point of time, the FANG Plus index did have good amount of exposure in the Greater China region. Okay, so one needs to be very cautious and understand the product thoroughly well. See, this index is going to consist not only of the US economy, but certain global economies and the China market as well. See, China market functions in a very different way. It's not only volatile, but it's going to be super cyclical also. So I feel, see, rather than although I'm a big fan of the FANG Plus index, I like to mitigate the risk in a much more better way. So if someone at this point of time is taking exposure in the US economy, stick with the US economy, which is the S&P 500, NASDAQ 100 index funds, or the FOF. Number 2, if someone is want to invest as a tactical allocation in the China or the Greater China region, rather than going for these different funds, which is the Nippon India, Hang Seng, Japan, Taiwan, there's this beautiful product called Edelweiss Greater China Offshore Fund. So Greater China Offshore Fund is the underlying instrument is the JP Morgan's Greater China Offshore Fund. It's beautifully managed, and it consists of 3 economies, which is the Taiwan region, the China region, and the Hong Kong region as well. So, keep your portfolios very simple, because we have seen clients and investors having a lot of products and falling into a tremendous amount of mess. US, it's NASDAQ 100 and S&P 500. If someone wants to take a Greater China exposure, then Edelweiss Greater China Offshore Fund would work best. But let's not forget one more thing. is that the China economy has a long road ahead. We have just seen some 35% or 40% of the upside, but we still have a very long, probably another 40-50% of upside just for the recovery stage itself. So at this point of time, I feel, till the time there is some consistency in upside opportunity and macroeconomical stability in the China region, I wouldn't put in a lot of money in the greater China region. I'm more comfortable putting in money in the US economy. But although, see, existing investors may have invested in the greater China region, and some time back we also had recommended investing in the greater China region, they can stay invested the way it is, because I do see with the cheap valuations what the greater China region has to offer, there can be a lot of upside opportunity, but it will take some time.
Yeah, and these Chinese and Hong Kong, exchanges or the stock act like broader market counters. I mean, there are days Hong Kong is down 5% and China is up 10%, and it gives up 15%. I mean, adds so much volatility to the portfolio, I would imagine. And Nisreen, in fact, just to quickly make a note, the Edelweiss Greater China Equity Fund has also done pretty well in terms of returns. The 1 month return is 3%, or 3 months it's done 14%, and 1 year it's upward of 20%. So it's actually had a good run, stable in that sense in the last 1 year. Nisreen, very simple question. If you want to take advantage of a currency, which is our local currency, depreciating, would investing in a fund of fund with a global allocation be a good idea? Could that help you make money when the local currency is declining against the dollar, say?
So definitely, I mean, you have to hedge the currency at every point of time. So you should be investing in the US dollars. You can also look at a multi-currency, multi-asset fund, which is an alternative. It would include gold as well as some amount of international equity. So I think that would be a very beautiful product to enter into. It has equity. It would have fixed income. It would have gold as well as international equity. So that is a product that you can use for your hedging purposes, because obviously you're also looking at the rupee depreciating at any point of time and also earning through the currency appreciation in any dollar fund that you would have. So rather than taking an individual bet, because it's really difficult for a retail investor to do that, I think we can leave it to the fund manager by investing in a multi-asset fund and having exposure to these various equity and debt classes, as well as which includes international equity. And I think the retail investor should have a longer term holding view, not a tactical view just for 2-3 months, because some of the funds we've discussed have shorter term very good returns. But in the last 3 years, they've been languishing, especially the China funds. So, if you are a long-term investor, you have a longer-term view, then definitely, you should be investing in a product which has various asset classes, and don't take a view for a particular asset class, like, only an international equity or only betting on the US dollar. So keep in mind all these factors, especially because, your risk-taking ability would be average.
Rishabh, we've got only about a minute to go, but two things that I want you to highlight for our viewers. So if there is an interest and if there is individuals who want to add on to some of these, you've obviously talked about the best way to do this is ETF, which is also low cost. But if one wants to look at a fund of fund, quick word on expense ratio, because these aren't cheap investments, and also lock-ins. Is that something one needs to be concerned about while you make that investment in these, even if your time horizon is long term?
Usually there will be no lock-ins unless and until someone pulls out the money before 1 year. There can be a 1% exit load from the AMC. I think even fund of funds would be very cheap in terms of expense ratio compared to the other active funds. Okay, so I would still prefer going into the passive route, because number one, it's easy to track and monitor, and number two, they relatively do have a lower expense ratio, even the FOF products, because see, FOFs ultimately will invest in foreign ETFs. So technically speaking, it will be lower. The expense ratio will be lower compared to the active side. Just one more point I wanted to add is that, investors can also look at, Indian mutual funds, say like Parag Parag Flexi Cap or SBI Focus funds, because they do invest abroad in the US economy as well. I mean, initially Parag Parikh invested around, say, close to 30% in the US economy, which is big because of the restrictions. They had to drop down their allocation to probably 17, 18%. So if someone doesn't want to take a separate exposure altogether in the US economy, I think going into the mix of Indian and foreign equities via the Indian mutual fund, which is Parag Parikh FlexiCap, what we recommend to our clients, and the SBI Focus Fund, I think they would be very well sorted.
I'm so glad you made this easier for us, Rishabh, because everyone suddenly is getting so excited and talking about allocations to Hong Kong, allocations to China, just because foreigners seem to be driving some of the liquidity there. But what we also understand from them, and I think that could be food for thought, is it's not a part of India that's going away to China. It's actually European money that's going into China at this stage. But great talking to you. Thank you for building that perspective. The best way to do this is, yes, you need geographical allocation, but you don't need to go overboard. The easier, cost-effective strategy to adopt is to do it through passive investing. US is a preferred market because there's transparency. Markets like China, it's very tough to know what's going on. The bias should remain to Indian markets, and funds like Parag Parikh, which do make that allocation to global equities, have been phenomenal performers. So you may not even need a fund of fund. A Parag Parikh in its own worth can actually play a good role for your portfolio. With that, we're completely out of time. Thank you for watching. There's a lot more programming on the other side, so keep it with us.